The Fed didn't cut rates this week, and that's not the bad news it might sound like. I'm Danielle Hale, Chief Economist at Realtor.com, here at the Austin, Texas headquarters to break down what this says about the economy and mortgage rates, and what it means for homebuyers, sellers, and the housing market. The Fed meeting and decision this week left the Fed's policy rate unchanged after a 3-meeting streak of cuts. While this may be a disappointment to homebuyers and sellers, it's actually a vote of confidence in the U.S. economy. Even though inflation is still too high, some components are easing. The labor market is cooler but steady, and economic growth remains on track, even if recent consumer confidence measures were low. Once again, there were dissents from the decision, but on the whole, this meeting was not a game changer for the mortgage market. Underscoring that point, this week mortgage rates were essentially unchanged, ticking up just 1 basis point. Although mortgage rates remain above 6%, high enough for the lock-in effect to continue to keep many homeowners in place, they are in the low 6s and down 85 basis points from a year ago, which has boosted buyer purchasing power. November Case-Shiller data based on fall home closings show that nationwide home price growth continued on par with what we saw in the prior month. Slower home sales price growth over the last 18 months reflects more market balance between buyers and sellers. A rising number of homes for sale has improved the balance between buyers and sellers, and Realtor.com weekly data show that generally continuing in January. Fortunately, new listing growth continues to bring buyers more options, and list price softening suggests that sellers are approaching the market with more moderate expectations in 2026. Notably, listing price softening is showing up in the luxury market as well as the overall market, with the biggest softening in the ultra and high-end luxury tiers in December. Still, entry-level luxury pricing nationwide starts at roughly 3 times the median home list price, with luxury markets like Bridgeport, Connecticut, Naples, and Miami, Florida, seeing pricing multiples of roughly 5 times the median home price. Finally, I want to turn from luxury to housing affordability, a unifying theme that runs through 2 of our recent reports. In the first report, we focus on homeowners associations, finding that a larger share of for-sale listings in 2025 included an association fee. Those fees were higher, and they were more common in the West and South. Importantly, HOA fees tend to boost the cost of buying a home the most in the South, especially Florida. In the second report, we examined the state of real estate in California, finding that the Golden State's structural housing shortage has pushed up both home rents and prices. The good news is that construction in the Golden State has been more affordable, but it is insufficient, and migration data show that housing-driven moves out of California rose 43% after the pandemic as housing costs soared. You can find all the details, including full reports and our housing data for download, at Realtor.com/research. You can also follow us on X, formerly Twitter, for real-time updates, and Instagram for graphics.